Well, I think if they don't cut rates in September, the markets may not like that because they're pretty much pricing in a cut, which is why I expect the cut to happen. The question is, are they going to go 25 basis points, 50 basis points? That's kind of where we are. But the broader point is that they shouldn't be cutting rates at all. In fact, not only should they not be cutting rates, they should be raising rates. They stopped raising rates too soon. Monetary policy never really became restrictive the way they claim. And the reduction that we've had in the official measures of inflation is only temporary. And I think that these rate cuts that are contemplated and will probably start in September will be the catalyst to cause inflation to rise to new highs, at least the way it's measured by the CPI. You know, the Fed claims that it's data dependent. Well, the most important data point when it comes to monetary policy and whether you're too loose or too easy is gold. And in fact, Alan Greenspan, who used to be the Fed chairman, when he was asked about it, he said that he uses gold. And at the time, gold was around $350 an ounce when he was answering this question before Congress. And he said, well, if I see the gold price up about 400, I know that I'm too easy. And if the gold price goes below 300, I know that I'm too tight. So he said, we're not officially on a gold standard, but unofficially we are, because I use gold as a guiding, a light to set policies. So I know if we're too easy or too tight. Well, by that, data point, gold's at 2,500. Gold's at an all-time record high. Gold's moved up 25% so far this calendar year in anticipation of the Fed cutting rates. Well, what does that tell you? That these rate cuts are a mistake. That is the data point that the Fed should be looking at. Also, look at the dollar, which hit a new 2024 low this week. It's now back to where it was in December of 2023. But what's more important is the trajectory. The dollar is falling, and it looks like it could fall substantially. Again, this is the currency market saying you're making a mistake, because the weak dollar in and of itself is going to push up consumer prices because we buy stuff with dollars. America has a $1 trillion a year trade deficit. We import all sorts of products that we pay for with dollars. Well, if the dollar goes down, the price of all those products has to go up by definition. So the Fed is about to make the inflation problem worse by claiming that it solved it. Right? So they're actually not cutting rates because they won the inflation war. They're cutting rates because they lost. It's a surrender, because they're looking at the impact that the higher interest rates are having on the economy, on employment, which is something that has to happen, because the low interest rates is the artificial support that boosted the economy. It created based on debt. And so when you raise interest rates, you make that debt that was accumulated when rates are low a big burden on the economy. So there's no way to normalize interest rates without collapsing the artificial economy that was built on top of the cheap money. But now the Fed doesn't want that to collapse, so it has to go back to the cheap money, which means we're going to get a lot more inflation. A lot of more unemployment than the government admits to. A lot of it is the way that it's calculated, because so many people have left the labor force that it really skews the unemployment numbers. And also the way we count the unemployed now is very different. We made a major change in 1994 to the way we figure out who's unemployed. And we took a lot of people that used to count, and we decided that they don't count anymore as unemployed. So that's the real reason the number is so low. In fact, we still report the number that we used to use, but it's beneath the headline, so nobody notices it, but it's called U6. And U6 was the actual only unemployment rate we used up until 1994, when they came up with U3. But what U6 does is it counts people who are unemployed, who want jobs, but they're just not looking anymore because they're discouraged. They've just given up. We don't count them now. You have to be out there looking for a job. And if you're not out there looking, you're not unemployed. Even though you're not working, and even though you'd want to work, the fact that you've given up hope means that you're no longer in the statistics. Then there's another category of people who have a part-time job. Let's say I've got a job and I work, 5 hours a week. But for the rest of the time, I'm looking for a job. But meanwhile, I got this little gig that I got 5 hours a week. They're not counted now as unemployed, because as long as you do 1 hour of work somewhere, even if you spend the other 40 hours a week looking for a better job, you're not counted as unemployed anymore. But in U6 you are, right? And they used to. So if you look at the U6 number, it's not 4.1. I think it's 7.9, or I forget what the last one was. It's actually, or it's pretty high. In fact, I looked back at the 53 years before 1994 to 1941. I'm not looking at the Depression because unemployment was high during the Depression. But starting after 1941 to 1994, there wasn't a single year of those 53 years where the unemployment rate ended as high as it is right now. So if you want to compare apples to apples, we don't have a low unemployment rate. We have a historically high unemployment rate. And it's going to get a lot higher. Meanwhile, the jobs that have supposedly been created are a myth. The vast majority of the jobs that Biden takes credit for creating were jobs that existed before he was elected. It's just that those jobs were on hold because of COVID. So the companies furloughed their workers because of the COVID lockdowns when Trump was president. Biden comes in, the economy reopens, and the businesses say, okay, everybody come back to work. Biden is calling those jobs that he created, but they were already there, right? Then, if you look at all the new jobs, in addition to those jobs, the restored jobs, that's all a myth, because we have fewer people that have full-time jobs now than when Biden was elected. So the jobs that were created under Biden were second and third jobs, because Americans could no longer make ends meet. There was so much inflation created that people couldn't get by on one job anymore. So a lot of people had to go out and get a second or a third job. Those are the jobs that are created. But the people who have those jobs would prefer not to have them. They don't want them, they need them, because their other job no longer pays the bills. So it's moonlighting, it's an explosion of moonlighting. And by the way, they also looked, if you dig deeper, all of the net new jobs went to immigrants. Whether they're illegal or legal, they didn't go to people who were born in America, right? They lost jobs. The net gain came to people that moved to America. So that also tells you something. And again, a lot of the jobs are in government, which are only here because we run huge deficits to provide people with government jobs. These are not productive jobs. We don't need these people. They're not producing anything that improves our lives, but we have to pay their salaries with inflation because we end up running higher deficits. So these are non-productive jobs. Then the other jobs are part-time jobs, in restaurants, in hotels, in bars. There's some healthcare jobs. We've lost manufacturing jobs. Those are the jobs we need, yet those are the jobs that have been destroyed during the last 3.5 years. So they were being destroyed even before Biden came around, but we've destroyed even more. So that's why the manufacturing industry has been in a recession for almost the entirety of the Biden presidency. Even by the government's own numbers, manufacturing's in a recession. Now, I think the whole economy is in a recession because I don't believe the numbers. But even if you take the numbers on face value, manufacturing's in a recession. And that's part of the problem with inflation, because we're not producing enough stuff. All we're doing is printing money to buy stuff that we don't produce, and so prices go up. And they're about to go up a lot more, once the Fed starts cutting and we start to see the impact on the weak dollar and what that does to commodity prices in particular.